Hi, welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. Sorry about that. My guest today is Craig Martin. Craig is a certified financial planner, and his company is the Family Wealth Consulting Group, and the principals are Craig and his wife, Peggy. And they are fee advisors. They provide asset management services. He's been doing that for about 40 years. Craig is the author of a book called Asset Class Investing, and I bet if you got in touch with Craig, he would be glad to provide a copy of that book for you.
Well, Mike, I'm going to interrupt you. You need to be complimented for running these interviews as a co-professional in the community. You've been interviewing the very best financial advisors, legal, tax, investments, and other people for a number of years, and recording the best people in the Valley. So I really compliment you on what you're doing here.
Great. Well, thank you for that, Craig. And thanks for joining me today.
Absolutely. Glad to do it.
Okay. Today, Craig and I are going to be talking about using alternative investments to reduce investment risk. And this is one of Craig's real niches, is bailiwicks.
Yes.
So I'm really pleased to have him here to talk about this with us here today. And so, Craig, people are talking about investment alternatives, and I think part of this is because people have been shell-shocked, with what's gone on in the stock market, and they're thinking about, well, what else can we do? Sometimes I think some of the choices that they make, that they're actually taking more risks than they would have been with stocks and bonds. So why don't you tell us about alternatives and
Sure.
and why are they, and maybe your experience about why they're so popular.
Sure. Alternatives, I define alternatives as anything but stocks or bonds. They're not marketable. So alternatives would be real estate or commodities or gold or that kind of thing. How about managed futures? And the Nobel laureate, Harry Markowitz, won the Nobel Prize when he helped us understand that managing the risk of the total portfolio was best accomplished by adding dissimilar price movement asset classes inside the portfolio. So stocks have a price movement pretty much one-to-one. All of them move closely together. But real estate does something different. When stocks do one thing, real estate probably does something different. Okay?
Well, maybe we can just say it's somewhat different. So
At least.
I mean, like right now in the Valley here, I mean, so, some stocks may be hot. The real estate is going crazy. So it's
Yes.
November 24th, 2015, folks. So anyway, so go ahead, Craig.
Yeah. So if we can add alternatives to a stock portfolio, we reduce the volatility of that stock portfolio. So when the stocks go up and down a lot, by themselves, your portfolio looks like this. But if we add dissimilar price movement asset classes into that portfolio, that volatility gets smaller. Hopefully we get the same rate of return. And we'll talk about that hopefully in a little bit.
Okay. So why don't you tell us again a little bit about this idea of managing risk of the total portfolio?
Yeah. So risk in the investment business is volatility of return over time. So the stock market has a volatility of about 18%, but averages about 10% rate of return. Over your lifetime, the stock market's earned about 10% per year. But that, if you think of it on a slope like this, it's not stable, it goes up and down.
Right.
How much does it go up or down? Well, it goes up 18% from 10, and it goes down 18%, but it averages 10. And managing that volatility and compressing that volatility from 18% down to 17% down to 15%, down to 10%, accomplishes two major tasks. First thing it does is give greater terminal value over your lifetime. So two portfolios, both earning 10% per year. One goes up and down by 18% per year. The other one earns the same 10%, but only goes up and down by about 15% per year.
Mm-hmm.
If you start at age 25 and go to age 65, the difference in terminal value between those two portfolios, both earning 10%, is about double.
Huh. Wow.
A lower volatility portfolio has nearly twice as much money at age 65 as the higher volatility portfolio. Then what are you going to do after 65? Now you want to spend
Right.
from that portfolio.
Right, you want to start drawing
Okay?
it for your retirement.
So the many independent studies have shown that the market, earning 10% per year but with 18% volatility, can only pay out about 4% per year.
And now they're saying maybe even less than that. Yeah.
Maybe less than that,
Yeah.
based on current numbers.
Yeah.
So you're earning 10 but can only spend 40% of that 10 or less.
Mm-hmm.
If you spend more than 4%,
You're
historical studies have shown that you'll run out of money in
Mm-hmm.
less than 21 years.
Uh-huh.
That's called outliving your money.
Right.
Okay? In contrast to a portfolio that's only got about 15% volatility to it, but earns the same 10%, or whatever the market returns have been,
Yeah.
that it can pay out about 6% and not run out of money.
So that's a big difference. I mean, that's like getting
50%
50%
difference.
more money that you can
Yeah.
pull out. Yeah.
For every $1 million under management, I can only spend $40,000 a year out of my market portfolio, but a risk managed portfolio, like what our clients have got, can spend $60,000 a year.
Mm-hmm.
That's a $20,000 a year, 50% more income.
That's the difference in being able to go out for dinner or not,
Or
right?
two, yes. Yes.
Okay. So maybe you can explain a little bit about efficiency for investments and how does the efficiency of the other investment alternatives compare to efficiency for the stock market?
Sure. So efficiency is a term that we use to describe the information that's available about stocks that's available to everybody.
Mm-hmm.
So there's no legal insider trading, which means all the information is publicly, freely available to everybody. Whether you're a professional money manager or Mike Ray or Craig Martin or even the viewers watching this show, you basically have available the same information across the markets. Mm-hmm. So if you want to study Cisco's stock, you can get the same information about Cisco that everybody else has got.
Mm-hmm.
And the people who do manage money, study that material,
Mm-hmm.
are brilliant.
Mm-hmm.
They are very, very, very smart people.
Uh-huh.
And they have teams of researchers that gather all this information and report. So it is unrealistic to expect any one of those very bright people to be able to find information in all that data research that's different, better than what other people are getting, understanding, interpreting.
Mm-hmm.
Once in a while, one of those managers will hit it right, and the next time somebody else will do it, and then somebody else. And it's very difficult to find somebody who can do that consistently.
Mm-hmm.
Because of that, we call the market efficient.
Mm-hmm.
The information is readily available to everybody.
So we're talking about like the publicly traded stock market.
Yeah.
Yeah.
The publicly traded stock market has perfect prices at all times. Mm-hmm. In other words, the information that's available causes people to make decisions about the price of that stock, and they trade it, mm-hmm. paying or buying or selling at that price.
Uh-huh.
Okay? So that price becomes efficient.
Mm-hmm.
It is the right price for that stock on
that
that
time.
trade.
Uh-huh.
Okay? We read the newspaper. For those of us who work all day at a different job, come home at night, read a newspaper about a company having a bad event or a great event. We may want to go out and trade on that the next day, but you have to realize that that information is anywhere from 1 to 10 hours old when we read it in the newspaper. And the number of trades per second on the stock market change frequently, but average a little over 15, 16,000 trades a second. Mm-hmm. For us, that means that information has already been included into that stock price when we read the newspaper at the end of the day. Mm-hmm. And the next day, there's no advantage to that information.
So even if you get the information, because now everybody's thinking, well, I don't read the newspaper at the end of the day. I'm watching the news on the internet as it happens.
Good.
But the point is that everybody else has that information, and in seconds, that is incorporated in whatever price that they're using. Yeah.
Yeah, literally.
Okay.
So inefficiencies would be when because the markets are efficient, we can't find anybody that can pick stocks and time the trades, perform all that research, and pick stocks and time the trades, and beat a simple buy and hold of the marketplace, an index. Okay, the index over our lifetime has outperformed everybody who's tried to pick and time. The people who are picking stocks and timing the trades, every one of them have underperformed a risk-adjusted benchmark over our lifetimes. In other words, it doesn't work. In contrast to an inefficient market, where in fact only a few people are able to know data research about a trade. That might happen in the real estate market.
Yeah.
For the viewers, nobody knows your home better than you do. When you sell your home, you know more about that home than the buyer probably does. And there may only be one person who's bidding on your home who has researched your home as well as you have. So that one buyer has legal insider information. Okay? That might also exist in a niche market where there's very little trading, and a expert in that market, commodities, precious metals, that kind of thing, would have access to information that very few other traders, if any, might have, and can trade on that instantaneously and make extra profits because of it. That inefficiency exists in those industries that I've described: real estate, managed futures, niche markets. Okay, and rather than try and find some guru manager who thinks she can pick stocks and time the trades and beat a benchmark, for my clients, I spend my time looking for people in inefficient markets, because I've got real estate managers that my clients have invested with that have 20 and 30-year track records of earning 2 or 3 times the returns of a risk-adjusted benchmark. So real estate typically, over the longest period of time, underperforms the stock market, earns about 6 to 8% per year, in contrast to the stock market, which earns closer to 10% per year. We have real estate managers in our portfolio that have 20 and 30-year track records of earning 20% per year or more. If you put $1 into each one of their deals, you'd have earned 20% or more. Some of those deals outperforming and some of them underperforming, but the average was 2 or 3 times an industry average. that convinces me that those markets are inefficient. And I need to spend my time looking for the people that can really harvest those inefficiencies consistently over the longest period of time and economically.
Right. And part of what we're talking about, though, and I'm just trying to think around some of the things that you're saying here, but we know that there are trade-offs. For example, like if you invest in the stock market, you have liquidity, you can sell your investments at any time. Real estate doesn't tend to be so liquid. And so you do have trade-offs for doing these. But the idea is that we have a portfolio, so we have some of this, some of that, to create the diversification that you're looking for, and to hopefully improve your return somewhat
yes.
over time.
Yes. At the beginning of the program, you started by saying that after the Great Recession, people were burned, and sometimes they make decisions that are dangerous to their portfolio.
Yes.
And part of that danger is concentrating into one thing. So for our clients, they're diversified between stocks and/or bonds. And many alternatives. And those investments are made over time rather than all in 1 year. So the illiquidity of any one investment only lasts for a limited period of time. It is scheduled to last for a limited period of time. And on average, every 5 to 7 years, those real estate addresses sell. So over a 5 to 7 year period, making investments each year, I've got investments from the first year that are liquid in the 5th year through the 7th year.
So it's sort of rolling.
So I've got, most of my clients have 15 to 25% of that portfolio going liquid every year.
Okay.
And the returns are well worth the wait if you can get 20%.
Right. What's the difference between the public and private real estate markets?
Well, public real estate markets are typically known as Real Estate Investment Trust, REIT. We acronym that REIT. And a REIT would own thousands of addresses. Typically, a commercial REIT would own thousands of commercial buildings. A multifamily REIT would own thousands of apartment complexes. The good news is, out of those 1,000 addresses, if any one of them underperforms, it's pretty inconsequential to the total portfolio. The same is true on the upside. Any outperformers, superior performers, also are pretty inconsequential because there's 998 others that are doing pretty normal. And earlier I said that real estate typically earns returns in the 6 to 8% range. During any one cycle. It could be higher or lower. But for a REIT that owns 1,000 addresses, they're going to earn the average. Law of large numbers says they're going to earn the average. So expecting more than 6 to 8% out of a REIT over many years of time is an unrealistic expectation. In contrast to owning individual addresses, just individually purchased and managed and sold by expert real estate managers who have a history of being able to buy a very low price, manage, increase the value, and sell profitably, consistently, and earn hopefully a multiple of what the average is, what the REITs are paying.
Okay. So we talked about...
Oh, you know, another thing to say, many people, viewers in this audience, own real estate as the major asset in their portfolio. It would be startling for many of them to realize that the equity growth on that property has been less than in the stock market. While they did, you know, they bought their property 20, 30 years ago and it's worth significantly more. That compared to the stock market, it's probably less. But also over a longest period of time, that growth is small relative to what a professional manager can do by buying, managing, and selling within a 5 to 7 year period consistently.
Yeah, I think that's the issue is the consistency,
Yeah.
and and predicting what's going to happen in the marketplace. Like I mentioned at the beginning, or somewhere along the way, that the things are crazy in the real estate market right now in the San Francisco and Silicon Valley area, because the economy has been so strong here recently, and more people moving into the area and so forth. So suddenly housing is a real issue and so on. But is that going to be a long-term trend? Is it going to hold up? And how you manage that consistently, when you have something again that probably is going to be again, we're going to experience market cycles here again, and so anyway, so people think about, well, I can make a fortune in real estate, but maybe so, maybe not.
Yeah.
And the other thing is that as you get older, again, you do portfolio management for probably, like I said, you've been a little senior in your group. Well, these people don't want to have to worry about, people having trouble with their toilet or their kitchen faucet or what have you. There's the management issue, and so it gives you some peace of mind to know that somebody is taking care of that, and meanwhile you can still get some benefits from
Absolutely.
participating in the marketplace.
Yeah, and a diversified portfolio with many managers. I mentioned earlier the law of large numbers. So if we put many managers into your portfolio over a many-year time frame, the law of large numbers says that we're probably going to earn an average of what we expected out of that portfolio. Some will outperform, some will underperform, but the average is going to do much, much better than a long-term buy and hold of real estate would, that any family might want to manage on their own.
How much of a portfolio do you think that somebody should allocate? I know that this is a little bit individual, but maybe you can give some rule of thumb or something like that, allocating to alternative investments as opposed to stock market.
Good question. So being a risk manager, we are expert at being a risk manager of a portfolio. We're able to get the returns of the marketplace with less volatility than the marketplace. The way we do that is to mix asset classes that have dissimilar price movement, and alternatives are a classic for doing that. By definition, alternatives have a dissimilar price movement to the stock market. So if we invest in alternatives representing about 10% of the total portfolio, the total portfolio of stocks plus 10% alternatives, 90% stocks plus 10% alternatives, the volatility will start to get smaller with 10% alternatives. Using 20% alternatives, we probably can get a significant reduction in risk, and somewhere between 20 and 40% into alternatives produces a portfolio that has significant less risk.
Right,
and
but a lot less liquidity.
And depending upon the alternatives we're using, it may have less liquidity, but it has significant less volatility.
Yeah, okay.
So the classic is Yale endowment, Harvard endowment, Stanford endowment, and they're using between 65 and 75% allocation to alternatives.
Really, that much?
Yes.
That high? 65, 75%?
Less than 30% in publicly traded stocks.
That's amazing.
Yes.
Wow. Okay, well, obviously those have a very long-term horizon for what they're investing for.
Yeah.
So we're about out of time, but what's the minimum investment required to invest in these types of private offerings, these alternative investments?
So most private equity deals require a minimum of $100,000 on their own. In the case of my clients, I've got a fund that my clients use, and each client has their own side fund.
Yeah.
And inside their side fund, they're able to choose which investment they want to put their money into and how much money they want to put into it and when they want to buy it. So that's how we do that, little tiny purchases every year. So a client may choose to put $10,000 in this real estate deal and $10,000 in that one and in this one. And I gather money from all my clients and write a $100,000 check or more to that syndicator so that my fund owns that investment. And then the investors share pro rata. An interesting part of this story, Mike, that has evolved since we got started is that whole story is going to change in the near future. We're going to have, under the Jobs Act, Title I, crowdfunding available to the equity investor. So today, I can only make a recommendation to buy alternatives to clients who are rich.
Yeah.
They're accredited investors based
Right.
upon the SEC Securities and Exchange Commission definition.
Right.
That means that they have $1 million of assets under management. And if they have less than $1 million, then they cannot participate in these alternatives. And if they have more, then I can recommend it in these portfolios.
Okay, great.
Crowdfunding is going to make it available to everybody.
Okay, good. Thanks a lot, Craig, for joining
Good.
me.
Good.
Folks, we're out of time. But anyway, so I hope that we've opened your mind here a little bit for alternatives that may be available to you. And we'll see you next time on Financial Insider Weekly.